today. So good morning, everyone. Great to see so many of you joined in today. And yes, for those of you who has joined from your bed with your coffee, we see you and we really respect the commitment. So I'll start with a question today. Let me ask you something. So how many of you have sat with a family member, maybe an uncle, a colleague, a neighbor, and watched them panic sell during a market dip? We've all been there, right? So you want to say something, but they've already opened Zerodha. Now, here's the wild part. India's mutual fund industry has grown 6 times in a single decade. Yes, 6 times. They have crores of new investors. SIPs are basically a dinner table topic now. The access problem, that's also largely solved. But the behavior problem, very much still alive and causing chaos. Because the moment Sensex drops a few points, what happens? Phones start buzzing, WhatsApp forwards multiply. Someone's cousin who follows the market suddenly becomes the most important person in the room. And their core SIP paused. So here's the real question. This is what we're digging into today. Who does the Indian investor actually listen to when fear kicks in? An app, a chart, a 60-second reel from someone with a ring light and a confident voice? Or do they still need a real human being, someone they can trust, who can just look them in the eye and say, chill, stay the course, we've got this? That's the gap. And honestly, that gap is your opportunity. Now, this is the second session in our Psychology of Indian Investor series. If you caught the first one with Mr. Sunil Subramaniam, you already know that this isn't your typical webinar. We're not here to talk products. We are here to understand the person, the fears, the biases, the behavior patterns, and basically everything that sits behind every investment decision. And to continue that conversation, we have the man himself back with us, Mr. Sunil Subramaniam, strategic advisor at Asset Plus Academy. Someone who spent years at the intersection of markets and mindset, and who has a genuine gift for making sense of why investors do what they do. Sunil sir, always a pleasure. I'll pass it on to you now. You can start with the session.
Uh, thanks a lot, Sonia, and good morning to everybody. Thank you for dialing in today. And like I mentioned just a few minutes ago, this is an English webinar. We will do a Hindi webinar of the same in a week or two, so not to worry. The second aspect is the title of the webinar is Psychology of Trust, and subtext there, if you can read, is why people still need a human advisor. But let me tell you that who is this webinar for, right? This webinar is for 3 types of individuals, right? One is, of course, that it is for the advisor himself, right? To understand how to handle your customer, right? That's one. See, it's also to a new advisor who's stepping into the business on how not to start off by doing mistakes and then correct their course, right? So that when they're starting off their journey, they can start on the right track. The third, of course, is that it's also for investors, right? Because it is targeted at why you need a human advisor. And before I go into the technicalities of the slide and the way it's structured, I just want to draw a small parallel, right? And because it's very, very relevant to this. So it refers to, I don't know if you ask your parents, I'm suspecting most of you are in the 30s and the 40s, so you may not have experienced what I'm talking about. When I grew up as a young child, the family had a family doctor. I don't see many families having family doctors. Today, everything is specialist. You go, anything you go to an Apollo hospital and straight away go and do a battery of tests. But there is this concept of a family doctor, and very often he was not an MBBS. He used to have a license called LMP, Licensed Medical Practitioner. Okay? And when you had anything, stomach pain, headache, neck ache, whatever aches, you just call him up. He will come over with his box full of items and he would talk to you. And then at the end of his talk, he would spend 15 minutes chatting with you, understanding what's happened, what's your family doing, what's your son doing, is his college admission, is his marks okay, irrelevant to the topic, or that your pain is there. By the time he's finished, you already felt better. And then he gives you a medicine And I'll tell you, I personally experienced this. Very often, I would forget to take the medicine, but I would feel better. Okay. And very often later, I discovered that those medicines were actually what is in English called placebos, which is plain, simple calcium carbonate tablets, but given as if there is a medical thing to it, like a crocin or ibuprofen. There's not. It's just calcium carbonate. It's a placebo, which means that you take it and you feel better. Where I'm coming from is that very often all our ailments, right, were psychological. They were triggered by some other stress or something else. They really didn't need any medication. And you just call him and he would talk to you. But just when he speaks to you, you feel better. And then whatever medication you give, you take it, you don't take, you feel better. And that was the nature of the medical profession then, before all these tests and everything. And Google doctor came up and everybody started Googling, right? It's exactly the same for our industry, right? And it is that dying breed of the family doctor, which is a very relevant breed in our industry, right? It is the calming effect of somebody you trust. That family doctor is a trusted individual. His very presence gives you a sense of calm, right? And you don't panic and go and do something like self-treating yourself with the latest medication and then causing damage to whatever else. So I think that's a parallel I wanted to start with, that the psychology of trust starts from the fact that ultimately the solution to investments is about having someone to trust, to whom you can speak when you are panicking, right? So I think that is a skill set which needs to be developed by MFDs, and which is what the focus of today's thing is. And so that you can understand that by using this, and for the psychology of trust to work, it is important that you yourself, as an MFD, are also an investor. So it's also about what you behave when you see the panic. Because if you are going to panic, then there's no way that you are going to get your customer not to panic. So first is, of course, this is also something for you to adapt yourself as an investor, so that you convey that. And then you build the trust, so that that ultimate is the alpha that you look to generate to the customer. The fund manager tries to deliver better returns than the benchmark as the alpha, but no, you are delivering solutions on which the foundation is trust. Okay. So on that basis, let me now go ahead with this presentation and briefly lay out to you what is it that we are going to speak about today. Right. So it's an 8-point program, right? It's 8 sets of slides here, where we talk about the illusion of scale, what we think we have scaled up as an industry. Have we really scaled up? 2 is that there's a vacuum of trust today, right? Because it's not there between the investor and the trusted advisor. 3rd is, of course, the behavior gap, which we need to understand. Then what is the cost if they try to go direct? The cost of no advisor, and why do-it-yourself investing fails for the majority, and the advantage that a human advisor brings to the table, and what is the opportunity set if you're able to crack that advisory trust factor. What is the opportunity in numbers? And then for a budding MFD, what it means in terms of a career, that this trust-based profession that you are going to kickstart for a new MFD, what does it mean for you in terms of a career, right? These are the points we're going to try to cover today. And let's talk about the first point, which is called the scale illusion, right? So our industry has never been bigger, but have the investors actually gotten better at investing because of this size of the industry? So look at the numbers, they're staggering. Yet in India, it is still very, very early in the whole investment penetration story, right? We were 12 lakh crores in AUM in 2016, 10 years ago. Today, we are 73 lakh crores. 6 times we have multiplied our industry's base, right? We have only 6 crore unique MF investors in a population of 140 crore plus. But the newer generation is not that. The older generation was risk averse, and that's why the penetration was low. But post-COVID, this number of 6 crores is doubled. In around COVID, it was around 3 crores. So this indicates that of course, people are more comfortable with the mutual industry, but they're also more comfortable with the risk, because the older generation, which was heavily trusting only in a fixed assured return schemes, there is an evidence, growing evidence that with the omitting of the demat account, that they are willing to tamper with risk. See, that's the important point. There's a mindset change in the younger generation, which is that they are willing to take risk, but they want to go and take it in the form of equity market stocks. And so if you now see that MF's share of household financial assets, when last we had a recorded data last year, was only 15%, right? And if you then look at the number of investors, don't add this 15 with this 95, the number of investors who are putting is 95% are still investing in FDs, LIC, PPF, post office, right? So you can clearly see that why do they put it in that? Because A, there's an institution that they trust, LIC, the bank, the post office, number one. Number two is the assured nature of the return, regardless of whether that inflation is being beaten or not, that assuredness carries a premium in their minds. Okay. So in the global context, we look at our growth, but look at the fact that in the US, it's 150% of GDP is a mutual fund industry. The UK, it's 75%, and the world average is 74, and India is at 21. Yes, there is an improvement. It was 17% a few years ago. It's now become 21%. Yes, there is an improvement there. But what we are saying is that if you look at the scale of growth of industry, have we done 6x growth in AUM, but have we done 6x growth in number of investors? Hardly. So, but what is the scale, right? Investor outcomes of their behavior is another way to measure. One is in terms of absolute numbers of penetration, it's still not there. But second is that those who are there, is their behavior reflecting this kind of what the scale should have done? Not at the same pace. So the SIP stoppage ratio, for example, in March 2026, it was 101%. This is for that month. There were more SIP numbers stopped, either because they matured or they were prematurely closed, than new SIPs brought in. So it is like 2 steps forward, 1 step back, 2 steps forward. So preventing these stoppages is one of the key elements of value addition from an advisor's perspective, from a customer to not go and close this SIP at the time of a panic-driven, either geopolitical or whatever situation, right? The second is the holding periods. 51% of MF units were redeemed within 2 years. So much for speaking about long-term investing. If you took a poll of investors when they invested, they wouldn't say they have a 2-year horizon. They will tell you they have a 10-year horizon. But it's actually more than half of the units are getting redeemed within 2 years. Why? Only one word for it: panic. Yes, a small proportion could say, oh, I intended to keep it, but suddenly I have this expense which I need to do. I have to do. Yes. But majority of this is because they started off with a 10-year outlook, but they want that 10 years to be everyday market going up. Little by little, little by little, 10 years they achieve the goal. The equity market is not that kind of an animal. It does not behave that way. It has ups and downs in its journey. And what this shows you is that half of the population is actually getting their money out before their goals are anywhere close to completion. Why? Again, the underlying factor is they need somebody to tell them that if they don't panic, what can happen? And that has to come from a trusted advisor, right? Next, if you see this stoppage ratio was 101, but it's been long. That particular month was a particular bad month, but it stayed about 75% from May 2025 itself, last 1 year, right? So even during the pandemic peak, it was not so bad. So what is happening now is that we've had a period of excellent returns post-pandemic for 2-3 years, and then we've had challenges in the market, and people are reacting not so well to this correction because A, their expectations were probably set much higher, and two is that they are seeing the geopolitical developments or whatever as a reason to take out their money, right? And then you look at the other aspect, right? We saw 22 crore demat accounts, right? But those demat accounts are used for what? Mostly for direct equity trading and for F&O trading. And you know, it's well publicized, SEBI study, which showed that 91% of F&O traders have lost money, and the aggregate loss is 1 lakh crore or 1 trillion rupees in a single year. So imagine the amount of wealth that has been given up by these people by putting their money into this. All their hard-earned money is just being lost in the stock market, right? And if you see, it's the newer generation. 40% of these F&O traders are under the age 30. And what is their basis of doing these decisions? The influencer generation, right? Who depend on the tips, the Instagram, the Reddit, and all that kind of stuff, right? So what is the real story? The real story is that while access to investing has scaled, investor behavior has not. And more information, thanks to Google and ChatGPT and Gemini, has not led to better decision making, and it's only produced more confusion. This is the reality that we need to be aware of when you become an advisor. So we now move to section 2, which was the trust vacuum. The trust in the financial institutions like the post office and the banks has not been transferred to a single reliable successor, right? So when you then look at it from that perspective, we have gone, where has the trust gone? From the institutions, it's moved to a fragmented, noisy ecosystem, right? So if you then look at it from that perspective, before 2010, it was the banks, LIC, post offices, trust was the default. Only the distribution, your post office agent, your LIC agent, only the distribution was human. The trust was the institution behind it, right? Then when you move to the period from 2010 to 2018, pre-COVID, that's when the digital disruption started. You got apps started coming up, robo-advisors, online platforms, direct plans. And then this led to then go, if I'm able to get this free from the technology, then why should I pay fees? They started questioning the fees to be paid to the agent concerned. And then we moved into the COVID and just post-COVID era when the influencers, the YouTube influencers suddenly mushroomed like everything, and Reddit tips and Twitter threads and advice became a commodity. You tap it out, you'll say, okay, buy this stock, it will double in so many months or so many days or so many years. And your need to get rich quick, which is what this whole demat account and younger generation wants, started getting fed by these influencer era. And from 2023 to now, what have you seen is that because these influencers have been so much, you've heard so many of these big cases of people have masked training as a way for you to get into F&O and all of that. So SEBI has removed 15,000 unregistered content pieces from the internet. So this absence of a trusted guide is hurting the industry in a big way. And so if you see, from one investor, one influencer from Pune, 546 crores was impounded by SEBI, right? And hence SEBI has been forced to act, saying any SEBI regulated entity of SEBI should not be participating or supporting in any way the unregistered financial association. The regulator is trying to act on its part, but there is still a huge part of this confusion that's getting created, right? So then we come to the next section, which is the behavior gap. So the evidence is clear. When the markets fall, investors consistently do the wrong thing, right? We know this time testedly, everything. And so if you now look at the data, right, AMFI's monthly data, right? This is the SIP stoppage count. So 75, 76, 85, 74, and suddenly in March, what happened in March? The geopolitical crisis, right? The war between Iran, Israel, and America, right, led to a spike. So clearly the investors are reacting to panic, right? So when you look at this, right, I wanted to tell you that you have to have some data with you on this. So if you stopped an SIP in Jan 2025, and you would have got an XIRR of 5% by September 2025, right? The cost of stopping. But if you had stayed invested, you would have got 6.1% plus more units at a lower price. This is just for that the period of that few months, right? So why does this happen? Two things, right? Investor behavior, there is a loss aversion. They don't like 1 rupee of loss is equal to 10 rupee of gains in investor's mind, right? So there's a loss aversion there. The second is the recency bias. What I don't care what happened, 3 years my returns, 5-year returns. No, my 6 months return is down, right? So my future is bad, right? That recency bias. So these are the two behavioral things, right? A desire to avoid loss of any kind, and a desire to, not a desire, but a tendency to take the most recent and project that into the future, right? So This short-term pain actually overwhelms their long-term logic, whatever you keep saying to them, that in the long run, equity markets have moved with the nominal GDP and have made returns like this. No, because there is people are acting on their own. Now, even within the advisory community, it happens with advisors who are not advising them properly. So it's both with DIY institutes and those who are treating this as a mere transaction phenomenon with the customer and not adding that trust overlay on their interaction with the customer, right? So the next section then is about the cost of no advisor. What if they didn't have an advisor? How is it? Can you try to look at the loss the customer is facing, right? So if you look, we already spoke about the 1 lakh crore of F&O losses. We also spoke about 91% of individual F&O traders. And we also spoke about the 51% MF redeemed. And you have seen that the last block on the right? Regular plan SIP investors who hold for 5+ years versus direct plan investors have stayed for 1.7 times longer, right? This is from the AMFI's annual report, right? So all this data that is down there, if you want to see the first line, we just covered in the previous slide, right? The second line also we covered, but in terms of with an advisor, what could happen? Somebody who's in F&O trading and has a 91% probability of losing money, right? Who's already experienced, it's for you to take that and say, put a portion of your money into a long-term SIP. It's just the behavioral approach that you have to take. And when people panic redemption in a crash, they've locked in the real losses and missed the recovery, right? So that's where your advice says that you pulled out the money and the market recovered and you came back in after the market recovered. So the entire bump up from the time the correction happened to the bump up, you have missed the rally, and then you're entering the rally after the rally has already significantly gained traction, right? And if you look at an FD and a PPF for 20 years, what do you get? You get average 6% returns. Times to times it varies, right? But the wealth at 6% would have grown only 3.2 times in 20 years, whereas at a 12% CAGR on an SIP, your wealth would have grown 9.6x, which means you can demonstrate to him that over a 20-year period, you would make 3 times the amount of money by just investing in an asset which has given him double the return, right? So that's some of the messaging that you can use to get people to rely on you for your advice and your right. And why DIY fails the majority of people? It's not about knowledge. Everyday knowledge is there at the drop of a hat, right? With all the AI tools available and the Google searches and everything, right? Knowledge is always available. But why it fails in the majority of people is that more information does not lead to better decision making. What we assume is you give investors apps and data, right? They'll make rational choices. And just because you give them knowledge, the outcomes will be good. And so we are treating do-it-yourself investing, right, as empowerment. In fact, the regulator also has been promoting direct plans, right? Because they believe that you give more information to the customer, you make better decisions. Far from the truth. What is the research telling us? It says that give them the apps, give them data, but only 15% household savings in equity plus MF, right? And 85% is still in FDs. 51% still redeem within 2 years, and 91% still lose money. So all of this do-your-universal facilitation through technology and through fin influencers hasn't led to any substantial either penetration or better decision making. Because the real problem is what? They fail on consistency, not on knowledge. It doesn't need you to be a smart investor to make money from the stock market. You can be a dumb investor. But if you are consistent to it, stick to your diversified asset allocation, right? You will make money. You don't need super knowledge to do that, right? Second is the fear greed phenomenon, the emotion riding the logic. When they make an investment decision, they talk about logic. Yes, sir, you said 10 years, I'll make this much money. Yes, but the emotions which happen when a panic attack hits overrides the logic. And that's where an advisor's role is to keep putting back that logic in his face in a gentle, consistent manner, right? And third is setting goals, but forgetting about them in the course of the journey. Why did I start what I wanted to do? I don't know, right? So one of the things which is, of course, important is that you pencil down what is the goal or the purpose of that investment and keep it with you so that you keep reminding yourself on why you're making that investment. Very often people forget why they did that investment and just treat it as, oh, one more, it's correcting, let me pull it out now, without realizing that there was a goal originally planned when you started the investment journey. Okay. And finally, point is that there's no accountability layer. You're not answerable to anybody. As an investor, you redeem and detail. So people will go and boast about their successes, but hide their losses. They'll not even talk about it. There's no accountability. Yes, maybe there is an accountability to your wife or your spouse, if you're a lady investor, to your spouse, if you have taken them along with you. But very often you don't. You just make the investment decision and you lose it, you quietly forget it. You win it, you come back and say, look how I made so much money from this. So there is no accountability. Whereas if you have an advisor across the table, you can hold him accountable to it. He made this decision and this, and he will have to give an answer saying that your goal is so many years away. This is what the past track record says, that when there is a correction, this is how it translates in the next 1 year, 2 years, 3 years, 5 years. So he can be held accountable. That's the beauty of having an advisor with you, is that he is accountable. Whereas you take your own decisions, accountability goes up into thin air, because are you going to punish yourself for making a bad decision? Not at all. Right? So then we come to the fact of what is actually, let's summarize what the advisor's advantage is, a human advisor. First of all, the human advisor is not a seller. He's not a product pusher. He's not a product seller. He's a guide foremost, right? And so the most valuable thing you can offer an investor is not the fund to sell. Think of yourself as a guide. So what are you giving? You're giving clarity. You're going to tell them these are the various type of asset classes. This is your risk profile. This is how you should do, and this is how you plan your financial plan to achieve your goals. You're a guide to him in the journey of investment, right? So first of all, so what is it that, from an advisor's perspective, that technology cannot replace? Behavior. No amount of technology can tell you how to behave, right? Holding the investor's hand during volatility, preventing that panic selling. That's number one. Number two, anchor to that goal. When he wants to redeem and panic, you tell him, no, you had planned for 3 years later to do this, to go on a cruise or to buy a car. So hang on till then. So every investment has to be connected to a life goal. Children's education, retirement, these are common ones, or home, but make it personal. You then don't, once you attach that saying this investment is my car, then you don't panic. Okay, it might be that your needs are not fulfilled in terms of what car you want to buy. You'll buy a lesser car. But once you personalize that decision making to a goal, that person's ability to stick with it through the pain of a correction or a panic situation is much, much higher. Right? That's the second role of a trusted advisor, is to be a goal anchor. And third, of course, is clarity provider. There's so much online noise and information which is useless. Everybody keeps talking about it. So you have to provide clarity and say, sir, don't listen to anything. What I send you, either as a WhatsApp or as a phone call or as an email, please read only that. You want to ask me questions? Please do. But do not go and search like today in the medical field. It's happening, right? Go to Google Doctor for everything. And then when things is not working, you go to your doctor. And when you tell that doctor that you went to Google, you know his response, right? So the job of you is to provide clarity, because he is unfortunate that he is inundated. It's not just from the internet, it's friends, everybody sitting in coffee across the, in the coffee break during the office. Somebody says, hey, I made this investment, I made so much money, right? So you have to stay away from that noise. And yes, feel free to throw questions at the advisor, and the advisor has to answer those questions. But that clarity providing is the key role of the advisor, right? Next is enforcing consistency. Right? So when times are bad, you should not reduce your allocation. In fact, you should stick with it. Ideal would be to grow it, but that requires a great challenge, because emotionally you're panicking. And when the advisor is telling you to put more, it's probably not going to work. But at least the discipline, reinforcing that discipline of staying invested through the bad times and the good times, is an important role that the advisor. So we're calling it the consistency enforce. You enforce it. You simply don't allow him to redeem, in the sense of keep saying no. If he says, can I redeem? No. keep saying no, no, no. You have to say 100 times no, right? Beyond that, if he goes, it's a different matter. But your role is to reinforce that consistency, right? Next is you're the trust holder. Why? Because when he is panicking, when he is in a crisis, he should have the comfort and the confidence to pick up the phone and speak to you and not do a DIY redemption, right? Straight away go into the AMFI website or AMC website or to CAMS or to Carvi and go redemption. No, you should build that trust quotient so that he calls you, and that right you have to allow him. You don't leave it as a missed call. You have to pick up that phone and talk to him. When you make a commitment that I'll call back in 10 minutes, you have to live up to that, because every small time you don't live up, your trust is getting damaged. So you are the holder of trust. So above all else, right, all the other things are actions, but the trust holder is who you are. You have to build that credibility, that you are always there to provide a patient here, to give him calm advice. That's very, very important. And that's the relationship. It compounds the longer it goes. So, along with his wealth compounding, this relationship also gets compounded. So, the 10-year trust relationship and the 20-year trust relationship, the 30-year trust relationship are obviously going to be miles in terms of that blindly they will put your faith in you when they, whatever, they need money, they're panicking or whatever, right? And finally, of course, is that we talked about goals and goals about anchor and consistency, but you have to position yourself as the financial life planner for all his future needs, right? It is the money that he has trusted you with, which you have to make sure is structured in a way that his full life till he passes away is taken care of in every aspect, right? So you are the lifestyle. So to the extent that it extends beyond his life, in sense he wants to build a trust, he wants to do estate planning and leave money for his grandchildren in a way that he wants to do all of it. You have to be that one-stop shop of trust that he comes back to, right? So, so if you do all of this, just want to end with a couple of slides around the opportunity in numbers. Yes, we know we have 6 crore investors, we have 1.75 enemies. So this is the gap where your carrier lives. The 6 crore investor, you only have 1 point less than 2 lakh MFDs, right? So that situation, right? It's only 40 investors per active MFD, and that is rising. India is adding investors 30 times faster than they're adding advisors. So there's a huge opportunity for new people who are keen to do. There's a huge opportunity for the children of MFDs to be told about, so that your succession planning as an MFD is also taken care of, that your children get motivated to join this industry, right? If you look at the potential of this industry, by 2030, it's going to be 100 lakh crore, but by 2035, 10 years from today, it's going to triple from that size itself, right? Which is 4x from today to 300 lakh crore, right? And penetration wise, the road is completely empty. We are at 21% of GDP versus 149% for the US and 75%, 74% for the world. So opportunity is huge, not at all a problem. And the carrier argument. So when a new MFD is starting off, he says, what is this? Some 1% trail commission. How long is going to work for me? And even to your children, to explain to them that this is not a job. It's a business that compounds with every client's wealth. Your business is also compounding. So just a couple of scenarios that we wanted to paint out here, right? So first of all, to a new MFD, right? Trail commission, the industry is got done away with upfronts. It's only 100% trail only income, but all income is recurring every month. Second, it accrues every day, but it's paid to you monthly. So must be aware of that. Third, it never expires. As long as your client stays invested, you earn. So it's in your interest to keep him invested. That's very obvious, right? Second is the markets grow your income. So it's not just the fund manager and the choice, the market itself, a 10% market rise, the 10% income rise, right? So look at it like an increment that in a salaried job you get from the boss, the market, right? And finally, SIPs are the way that you increase this compounding, because every new SIP installment adds to your AUM base and adds what, 60 to 120 installments of that same amount to the future, right? So these are 5 things for a new MFD to be aware. And then when you look at your AUM and you put certain scenarios out, let's say you garner an AUM of 5 crores and you're getting a trail rate of 1%, let's say. The income that you will get is about 40 odd thousand rupees a month. It's 5 lakhs per annum, right? This is a base level of an MFD. As you then, if you quadruple your AUM, assume that as you grow, then what happens is your product bouquet will also change to incorporate large size funds of very good AMCs where the trail commission comes down. It incorporate a bit of debt, so your trail commission will not be the same as an equity. Will incorporate a bit of hybrids. So let's assume that your trail rate comes down to 75 basis points. Even then, at a 20 crore, you will be earning about 1.25 lakhs a month, which is 15 lakhs per annum. Now, let's say you grow your thing to 250% to 50 crore, right? And your trail, let's say, staggers down because of the funds that you invested in have grown larger in size, 2.7%. You still make almost 3 lakhs a month and at 35 lakhs per annum. And won't you touch the magical figure of 100 crore in AUM and take another 10 basis points drop in your trail commission too, you will still be earning 5 lakhs a month and 50 lakhs or 60 lakhs per annum. So it is a very profitable industry. And mind you, a part of this AUM growth is not necessarily just new sales, it's the market action playing, right? So the market action will still add AUM to you and your income grows with that. On top of it, your addition of new clients or penetrating your existing customers' wallet in a much greater manner will add up this, right? And if you look at it from Amphi's data that we have taken, MFD incomes have grown 16x in 20 years, whereas for salaried employees, their incomes have grown only 4x in the 2020 year. So like an entrepreneur in a business, right, the starting will be tough. But because we are in the nature of a business which has a recurring income, very few businesses in the marketplace have that. Because it's a recurring income driven by markets, driven by new customer acquisition, driven by customer penetration, right? Your growth rate will be much, much faster. So when you start off, you may feel that your friend from college or your cousin has got a bigger salaried income than you. But it's a matter of time before you will overtake him and leave him far, far behind, right? So 10 crore AUM in 5 years is equal to 6.6 lakh income, trail income. That's what we have taken from the Amphi's estimates, right? So with that, I think that I want to summarize with saying that the trusted MFD is the rarest role in Indian finance. Why is it rare? MFDs itself are rare, and then trusted MFDs are even rarer, right? So from that point of view, one, a market that grows with you, right? You grow, the market grows, you grow with it. You're solving a proven problem, right? You know people are losing money in F&O. You know people are redeeming their SIPs before they are maturing. You know people are panicking. The average investment period is only 2 years. So all of these, there's a problem there. And you have to look at it as I'm stepping out to solve that problem. You're not stepping out to sell funds. You're stepping out to solve a problem which exists or which data shows that people are gambling, people are risk covers, people are panicking. So all of these are your problems which you need to solve, right? And today technology, while it's supposed to be favoring the DIY investor, for a distributor, it's a phenomenal task because it reduces your costs and you have platforms like Asset Plus, which take over the entire backbone for you, including what funds to choose also. So you can solely focus on one thing. What is that? Don't tell me the answer is selling to new customers or selling. No, your answer is building that trust. So think of your business as building trust. And for that, Asset Plus like companies are providing all the tools to you so that you can focus on the emotional trust building with the customer base. And then that word of mouth from that customer will get you more customers. Okay. So that's the thing, that you have to not become a slave to the technology, but making the technology work for you, which is where that's the thing, to have a very good backbone of technology with you. And India is still very early in this whole investment penetration story. We've seen that number multiple times in the course of today itself. And entry is simple, but ceiling is high. Why do we say that? It's one NISM exam to pass, one ARN number to get. But a carrier that can generate 60 lakhs a year at 100 crore AUM entirely through recurring compounding income model, right? So It's a very simple business to enter, but the ceiling is high because that ceiling has to be breaking the trust, overcoming the trust barrier, and building a trust-based relationship with your customer, right? So, to sum away the takeaway, India does not have a mutual fund problem. It has a trust and guidance gap. Every investor you guide is a problem you solve, not for them alone, but for the financial future of their family. So the MFD's role is not a sales role, it is a calling. It is a something which you have been called upon to do to solve for the nation. Right. So what is the step-by-step process? Becoming the trusted guide that India needs. So first clear the NISM 5A exam, right? It's a mutual distribution exam, just one exam. Get your ARN code, register with AMFI, your license to operate as a certified compliant MFD, and then you have a choice of building with Asset Plus because you get technology, you get training, you get a community to help you grow from day one so that you focus on clients, you focus on building trust with them, and Asset Plus will take care of the rest, right? So thank you very, very much, and happy to open the floor for any questions if you do have.
Thank you so much, Sunil sir, for sharing your insights with us today. We now know that India doesn't really have a mutual fund problem. It rather has a trust and guidance gap, and that's exactly where the role of a human advisor becomes irreplaceable. And Sunil sir has reminded us that clarity, conviction, and consistency are truly what drive investor success, not just access to apps or endless information. So, with that, we will be taking up questions. Someone had already asked that how to start the process. I think Sunil sir has already explained that to us. You just have to clear the NISM 5A. For that, we provide courses, we provide training so that you can clear the exam with flying colors. And after that, you have to take your ARN and panel with Asset Plus. So we open the floor to more questions. If you have any questions, feel free to drop them in the Q&A section. We'll be taking them up one by one. Okay, we already have a few questions. So how to build your first new set of clients for a new MFD? Believe the first few would be the hardest to build trust with.
Absolutely. It's always the first step, which is the difficult one. So I think the first is that once you clear the exam and do it, you have to reach out to your friends circle to go and talk to them, right? Obviously, like any new business starts off, it has to start off somewhere. So you have your own friend circle, you'll have your relative circle, you'll have your college classmates who are there, with whom you maintain a contact and networking. Uh, you will have membership in some society, in your apartment building society. Just set up a small time, say that I have started this business, I'd like to help you with that. Can you spare 15 minutes of your time? And I'm sure that if you are trying to sign up with Asset Plus, they'll give you a starter kit, which will explain how do you break the ice, how do you actually open a conversation, how do you not appear as a product seller but as a financial coach. I'm sure they are there to help you and guide you in the process.
Thank you for answering. We have one more question. So someone's asking, can we recommend funds after passing NISM 5A or ARN is required? ARN is required. It's the license to practice mutual fund distribution. So you will need your ARN. So we'll be taking a few more questions. We are almost running out of time. So someone has asked how to handle the fees or commission one gets part when a client asks.
So you don't you tell them that you get paid by the fund management company. So you don't need to charge him anything. And so you can tell them that depending on various funds and various sizes of the funds, I get differentiated commission. So I think that's the best. If he's still more curious, you can tell him that you can go to the website of the asset management company whose product you sold. They are supposed to disclose the kind of fee structure they give. So guide them to go to the asset management company's website so that they will give you what is the regular plan, what is the direct plan. They're supposed to regulatorily disclose that. But you don't have to tell them what you are getting from that aims. You can tell them that it varies from time to time based on the situation and whatever.
Okay, we'll take one last question. Do you have any specific book recommendations on building trust?
I think trust is not something you can read a book and do it, because it's about actions. Uh, Books always give you a very standardized stuff, but life throws at you so many different situations. So trust is it's something that only grows with practice. And so I think hopefully the points that we are in there in this webinar itself you can take as a guide. But the point is that obviously discipline, there's a slide there which summarized what all you're supposed to do, right? So focusing on his life goals, be a financial life planner, set out the goals and keep reminding him that that as investment is for that goal, telling him to stay consistent and disciplined, not panic. So these are all the things which are actions which build trust. Trust is not from words, trust is from actions. So you have to demonstrate. You yourself should not panic in a geopolitical situation. So you have to first build that confidence and comfort in yourself about the long term potential of our equity and capital markets. And second is you have to always put the client first. So at no point do you think, for example, your trust can easily get destroyed if there are two funds and one fund is underperforming the data set that you can easily access today. Everybody gets data, but you're selling the fund which is giving you a higher commission. So that's straight away something that will damage the trust, because if he come to know and he Googles and he finds it's the worst performing fund and you sold it to him, right? So if you're going to sell a worst performing fund because you believe it will do better, you have to take him into confidence and say why. Be upfront with him. Tell him that this is not performing well, but you've had a discussion with the AMC and the fund manager. They positioned the portfolio this way, which did not work in the past, but the positioning that they currently hold will deliver in the future, and you have the confidence. So the trust comes from being transparent with your fund selection process, being transparent with how it fits the goal. So it's all about actions. So I will say that you go into a bookshop and you'll find a lot of these. You search online also in Amazon or something, you'll say trust, there'll be books. But my recommendation is that it's very, very hard to take the books thing and keep that as a guide. It's about, it has to come from the heart. It has to come from your actions. That are you thinking client first? Are you communicating that you're thinking of the client first? And do your actions demonstrate that you have acted in his interest? It's a repeated practice of these small, small steps which will build the trust. So I would not suggest you to go and read any book. Trust is a very nebulous cloud-like thing. You can see the cloud, but can you touch a cloud? You can't, right? So it's very similar to that. So I would say just start practicing these small steps. And every time there's a panic situation, every time there's a doubt, every time the customer comes to you with a question, are you responding in genuinely in your mind with the customer's best interest? And are you communicating that to him? These are the repeated steps that you have to practice. It's just like walking 10,000 steps a day or whatever that you do. Discipline, consistent reinforcement by your actions. Words are important, right? But words are not enough, right? You have to back the words with your actions to the customer.
Thank you so much, Sunil sir, for answering all of those questions with such clarity. And all of you, thank you once again for joining us on a Saturday morning. We hope you leave with a stronger sense of why trust matters more than ever in investing. Now, for those of you who want to start with the process, we'll be sending out emails with the registration link. If you're interested, feel free to enroll yourself. We'll be reaching out to you and help you with the next steps on how you can get started and become a mutual fund distributor. A lot of you were also asking about a Hindi session. Please be informed that we'll be back with a Hindi session for the same topic on 16th of May. You can join that as well. We'll be sending the links for that. So feel free to register yourself. We'll be once again back with another session. Have a great day. Have a great weekend, everyone. And we look forward to seeing you in our next session. Thank you. Thank you so much, everyone.
Thank you, and all the very best to all of you.